Good morning, ladies and gentlemen, and welcome today to our China webinar for the quarter 2023 quarter two. Joining me today is Tian Pan and Liang. They are, of course, based in Shanghai, which is excellent for us as a company, as we really have people in China looking at what the market. Now, there's been a lot of optimism coming out of China the last couple of months, and today we are going to depict all the economic data and policy releases and necessarily why it hasn't shown in markets just yet. But as Tian has spoken to me before, there's some very good optimistic news coming out of markets in China. As always, we like to keep this interactive, so please feel free to ask any questions in the Q&A section. And if we have time, we will cover as many as we can. But for now, Tian, Liang, good morning, guys. Nice to see you. And yeah, take it from here.
Well, thanks, Chris, and morning, everyone. It's nice to see everyone online again. And we've had a good week in the Chinese market. So today, I think I'm going to take the first part of the presentation, take everyone through a lot of the hard data that's come out of the market, following on from my trip to SA. A couple of months ago, firstly, we want to continue sort of our focus on filtering through media noise. Sentiment in the market is very, very volatile. It turns from negative to positive very, very quickly, and affects a lot of flows, affects the markets significantly here in China. This is a typical headline. This is from Bloomberg a few days ago. So if we look at the main headline on the front page of Bloomberg website, it says Chinese stimulus signals the stocks to rally. We often get confused by a lot of, again, volatile media headlines as you see sort of a sub-headlines is China holds off on major stimulus. And that's pretty much been the story of the media messages that have come out. It's often been pessimistic, but it's often been very confusing. And today we'd like to try and unpack a lot of the hard data underlying these headlines and give our clients and followers a clear message of what's really happening on the ground. So first, filter through the media noise, and what we want to do is find out what's really happening on the ground here in China. Firstly, we believe the economy is very strong. Economic fundamentals are strong, contrary to some of the pessimistic media headlines. So we've all seen headlines saying China's GDP growth has missed estimates and missed expectations. So here I have Chinese GDP growth for Q1 and Q2 right on the left-hand side. And then it's compared to developed market and emerging market peers. In the emerging markets, we picked sort of the toughest peer for China with India. Its GDP growth in Q1 was 6.1%, the best of major emerging market economies, Japan, Germany, UK, US. You can see China way above everybody else. So relatively, aside from India, China is miles ahead of everybody else. China Q2 GDP growth number came out at 6.3%, which is below the expected 7%. But the questions we have been asking our clients after the data releases, would you rather prefer a 6.3% growth rate that missed expectations, or something like the US growth rate at 1.8%, which was actually above expectation? I mean, the absolute number is just not in the same league, and we're very confident on Chinese economic growth. One of the reasons why people have been pessimistic, and along with the media, is that Chinese equity markets haven't really followed through with economic performance. So if we look at this XY plot, all of this, it's the GDP growth, cumulative GDP growth since 2020. So since the onset of COVID, up until end of quarter one 2023, compared to equity market performance as at the end of quarter two 2023. You can see China at the bottom right-hand corner, the two main Chinese markets, China A and China H, doing significantly worse than everybody else. So India, for example, cumulatively has done 42%, and the US 46%, and China actually in negative territory, even though economic-wise, they've done better. So we believe there's a lot of catching up to do. You'll see in the next slides how valuations differ as well. But quickly to cover the sort of inflation and monetary environment in China, very, very stable. So Chinese inflation, very low. That means there's high real rates in China. It's about 2%. The real return is about 2% in China. It also gives the central bank a lot of room to cut to still have a real rate. So central bank is not expected to cut a lot. We saw that they cut interest rates by 10 basis points back in June. We expect another cut or two in the coming quarters to further support the economy. There has been some concerns about deflation. We are not too worried about deflation in China. The latest reading is zero, absolutely zero year on year for CPI. But we have seen sort of similar trends before. And if we look at the IMF expectations of a 3.2% inflation rate for the year of 2023, we can see that overall for the year, there's no expectation of deflation, even though we believe that 3.2% may be slightly high. Looking at the strength of the Chinese economy, we can see that when we compare China to itself, we see that export growth year on year is declining, but China being a very export-focused economy is still consistently increasing its trade surplus. Whereas if we compare it to its major exporting peers, Germany, Japan, and South Korea, you can see that on a rolling 12-month basis, all of the other three economies, also major exporters, also dominant economies in the G20, are running into trade deficit territory. Germany is still overall in a trade surplus, but on a rolling month-to-month basis, often hitting a deficit territory. And that's more of a function of a depressed global economic environment rather than something China-specific. And under the same tough conditions, China is actually holding up very, very well. Same story with PMI. We've seen a lot of headlines covering Chinese manufacturing PMI to be below 50 and in contraction territory. Yes, it is below 50 and it is slightly in contraction territory, but again, compared to other major exporting economies that depend on global demand for their manufactured goods, China is relatively in a very, very strong spot. If we look at Germany's latest manufacturing PMI number from June, it is close to 40. It is much, it's the green line right at the bottom, much weaker than China. South Korea also suffering. Japan is the only one that's close to 50. China's numbers is two lines, the two dotted lines. The reddish line is the official China manufacturing PMI. That's slightly below 50. And the blue/green dotted line, the Caixin Chinese manufacturing PMI, that's more weighted towards small, medium enterprise. That's actually slightly above 50, showing expansion. And we're very, very sort of optimistic and confident seeing that data because it means the private sector is actually more confident than the state sector. So we're actually very happy about that. And we await to see new PMI data being released. So the Caixin one comes out in a couple of days' time. The July numbers have come out already as of this morning, and there are a slight improvement from the June numbers again. So overall, we continue to expect improving economic data coming out of China. If we look at consumption data, a lot of media headlines talking about Chinese consumption not really meeting expectations. We often feel the media have very, very high expectations. So first example is Dragon Boat Festival, which was about a month ago in June. It's a short public holiday, sort of a 3-day long weekend. If we look at the spending, it was up 45%. So this data is based on tourism spending over the long weekend. It was up 45% compared to 2022, up 27% compared to 2021. Remember, there were no lockdowns in China back in 2021 related to COVID. The numbers are only slightly below 2019 levels. And the media, of course, chose to focus on the fact that 23 numbers were below 2019. But we continue to focus on the trend, and it's strongly recovering from the COVID state. And we expect next year's numbers to be even stronger. The May 1st Workers' Day holidays, which is a much longer, sort of a 5-day national holiday here in China, these numbers look much better. And it's actually a more significant tourism consumption number. It's up 26% compared to 2019, 31% compared to 2021, and 129% compared to 2022. So all of this, again, shows even on the consumption side, Chinese economic data are looking very strong. So overall, we're very optimistic, again, on China. And that's it sort of for data. Over the next few slides, I'll cover a little bit of policy update from China and the Chinese authorities. I think geopolitics is often the focus on China these days. Ongoing dialogue with the US, there hasn't been much significant progress this quarter. We're seeing Antony Blinken visiting Beijing, Janet Yellen also visiting China, John Kerry in terms of climate change negotiations visiting China, and lastly, Henry Kissinger, the seasoned diplomat that actually laid the ground for China-US diplomatic relations to be normalized back in the 70s, visited China. So this is quite positive. We don't expect overall China-US relations to get much better, but continuing dialogue and continued activity means that both sides want to manage risks, so we don't see the relationship or deterioration getting out of control. That's quite a positive. With Europe, we saw after French President Emmanuel Macron and German Prime Minister, along with other senior members of German government visiting China earlier in the year, Premier Li Chang now returning the favor, if I can call it, visiting Europe, especially to France and Germany, the two leading and dominant economies within the EU. Again, China-European relations, a lot of engagement, nothing concrete in terms of announced progress, but with all of this engagement, we expect progress, especially, for example, on the China-Europe Investment Pact that's been on ice for a couple of years already. So hopefully that'll be revived. That's going to be another kick on the economy. In terms of China and its neighbors, the one significant progress was the South China Sea dispute. So the code of conduct of all the countries within the region of how to operate within the South China Sea has passed the second reading, and we expect that to be finalized and signed by all the nations in the region later this year. Again, that's another stability factor in the area. So overall, very positive on sort of the politics front. On the economy front, I think one slide covers it all. There's been a range of policies from the Chinese government that's come out to boost consumption. So there was an 11-point plan that came out, for example, encouraging people to buy more appliances and new smart furniture, for example, improving old age homes, improving old communities, sort of mini infrastructure. There's extension of tax exemptions on new energy vehicles, loan relief for the property sector. All of this has come through to be read as very positive. So the government spoke and then the policy followed. So we saw the market really liking that over the past week and a half or so. That's why the Chinese markets have rallied over the past week. There's again official pledge to improve conditions for private business. All of these things are very positive. So we're seeing valuations are good, sentiment turning positive now, and we've got a lot of policy support. So overall, everything is coming around to China, and we expect the market to have a good rally coming forward. Hopefully, the last week's rally is an extension, will extend into the future. With that, I'm going to pass on to Liang to go through some of the market data and our fund position.
Thank you very much, Tian. I think to really help people understand what's been happening in the market over the last 2 years, I'm going to kick off by just showing everyone the suite of products we have in China. So starting off with, we have the purple line, which is a China equity index. So there we're matched by our Prescient China equity fund. As you can see, equity is of course on the way down, and on the way up, you get close to 100% equity. We look exactly like the equity index, but over time, we have a little bit of outperformance, and that accumulates over the long term. And by accumulating small bits of outperformance, we're about 5 months away from our 5-year track record in our equity fund. And since we started over the past 5 years, we should be comfortably in the top decile versus our competitors. Taking a step up next, we have our balance fund. So we have a 65-35 composite in the dark blue line, and the gold line is our balance fund. As you can see in our balance fund, what we really try to do is to give clients on the downside, similar to 65-35, sometimes a little bit less, but then on the upside, we want clients to have a lot more, especially under the conditions where market valuation are reasonably cheap, as well as policy are reasonably supportive. So you can see that on the way down from 2022 January all the way down to October 2022, we're about 65% of the downside. And on the rebound, we got almost 100% of the upside, resulting in massive outperformance towards the end of first quarter 2023. Unfortunately, last quarter, we had to give back a lot of that alpha since the market pretty much went back down towards the lows of the year. But once again, what we do in asset allocation, how we try to outperform, we'll maintain there. So should the market continue to recover from here, what we expect is a balance fund to outperform 65-35 materially and looking more similar to an equity fund on the upside, so on the downside, a more traditional balance fund. Then finally, in the previous year, we launched our hedge funds. And the hedge funds is one more avenue giving our clients access to China. So they have been Section 65. We have an onshore gear, which is a green line, which only deals with the China onshore market. And then we have an offshore gear, which is what our clients in South Africa have access to, which is a red line. And suddenly, once again, what you can clearly see is just how an extra layer of downside protection is there. So for any calendar year, our clients will never lose more than 5%. And on the way up, sometimes a little bit slow, but as we stand right here, our nominal equity exposure is actually extremely high. It's close to 140%. And our effective equity exposure is close to 70%. And that's because we have the lowest implied volatility in China at the moment. So we have all different products for all different risk criteria with asset allocation, with stock picking. It's up to our clients to decide which one to go into. Taking a step further, looking at our models, if you look at our valuation model, China, once again, as mentioned by Tian, stands out. We have low inflation, low interest rates, but PE ratios that are in the low double digits, even the high single digits when you look at the Hong Kong market. On the right-hand side, what you can see is the bars are actually the earnings base of China. And the red line, the orange line, is the PE. So you can see that the PE ratio are towards the low end. Other than when we started our fund a decade ago, PE ratios have probably never been lower. And vice versa, we're not looking at peak earnings. We're looking at earnings that's been harmed significantly from the COVID lockdowns last year. I think COVID has been at the back of a lot of people's minds for a long time overseas. But in China, we actually had the biggest wave of Omicron only December last year. So we're a couple of months coming out of COVID still. As going forward, we would expect corporate profits to normalize as we go forward. Right, looking at our models, often we get a question, well, under what type of scenarios do our models struggle? And this time, it really is one of those situations. So as we mentioned, what we show here is our sentiment model, the blue line as a CSI 300 index, and the orange and green being sentiment, kind of the two sentiment models that runs over time. And I think right in the beginning, you can see that in 2020, 2021, sentiment was 100 and cut to zero very, very quickly and stayed at zero all the way till January 2023, where sentiment boosted to almost 100. Now, on the back of attractive valuations as well as supportive policy, we of course upped the equity exposure per our model, and that worked quite well for Q1 of 2023. Unfortunately, in Q2, market fell back, sentiment quickly got cut from 100 back down to zero and stayed at zero for the last quarter. And it's only as of yesterday, actually, sentiment's back at 100. And I think that's kind of what's happening in the Chinese market. And under those circumstances, it is difficult. As such, we had a difficult quarter. However, our process is trying to test it over the long term. And we do think over the long term, we'll comfortably outperform the benchmark. Finally, early on in the year, we talked about how we make use of derivatives in our balance fund, and we still do. And looking at derivatives right now, as we mentioned, the pricing is great. And the entire principle of using derivatives is also how we've been able to give our clients downside similar to 65% with some protection on the downside, that we have some negative alpha, but never that high over a year, something like -1% out for the worst case scenario. But when the markets go up, we have close to 80, 90, or even 100% equity. And we can get a better risk reward payoff by making use of all instruments available to us in the market. Right, looking at performance, as we mentioned, over the past quarter and year to date, it's been tough. We had to give about the 3% alpha we made in Q1, and that's been lost in Q2. But over the long term, as you can see, compared to inflation +3, compared to the 65-35 benchmark, we've almost doubled the performance after fees. Right, and over whether you look at 3-year, 5-year, 10-year, or overall, on a risk-adjusted basis, we're 5-star rated on Morningstar, beating most of our peers over the long term. Right, so very, very quickly, as Tian mentioned earlier, we think that patients will be rewarded. It's been a frustrating couple of years in China, but the fundamentals are pretty solid. And one of the key things we always tell our clients is that timing in China is very, very difficult. It's why having the balance fund where we're on the ground, where we can make asset allocation changes, is so crucial. So all we're showing here is just how quick sentiment can change. So if you look at last week in terms of news, it was nothing that big. Everything that the government has done was previously announced and then released. There's nothing that big, but perhaps one thing that dramatically changed was the sentiment. The sentiment in the market, for whatever reason, all of a sudden changed. So as we've shown on the 22nd, 23rd, you can see that the market started off pretty flat, and within a week, in the green line, the S&P is up 1%, the CSI 300 is up 4%, the HSCEI is up over 7%, and the tech sector of Chinese stocks is up 13% in less than 1 week. And that's once again what we see of how fast sentiment can change in China. So that's why we think you do have to stay invested and wait throughout the cycle. The timing of this thing is extremely difficult, especially if you have to transfer money overseas and then buy funds, etc., etc. Right, so in summary, we really think that if you look at the data overall, we think the data is not fantastic, but absolutely not bad. It's certainly not bad in comparison. So we think if you look at the hard data, China's doing fine. It's not as good as the old China growing at 10%, and that's not ever going to come back. The nature of the Chinese economy has changed. The old hyper-growth era is definitely over. And what we see going forward is normalized growth. But those normalized growth should not see a discount of equity market to such a big extent. We do think there's a lot of opportunities in China. That's why active management is key in China. And I think using dynamic asset derivatives will give our clients attractive upside with limited downside. And finally, Tian thinks it's time to be greedy when others fearful. So it's a good time to add exposure to China. From my side, I do think, except for when we started the fund in 2012, this does seem to be one of the most attractive valuations that we've seen in China over the past decade. And I think being on the ground, seeing everything develop, I think typically the fears of the collapse in China is massively overblown. And given that's been the case, we do think it's a good time to allocate to China with a diversification, with a potential of outperformance. Right, thank you very much. We'll stop there and open it up for questions.
Yeah, cool guys, just one sec. So first of all, just a little bit of admin from our side. First of all, ladies and gentlemen, thank you for joining us. We would like to emphasize that there is an investment trip going to China in October. So if you would like to join us and meet Tian and Liang and see exactly how China works, please feel free to contact your business development manager, and so we can set it up. And then secondly, the guys spoke about the gearing of the gear solution that they have. So also this adds a little bit of diversification to clients' portfolio. It is a bit of a lump sum amount of 1 million Rand needed. So also please feel free to ask your BDM about the gear investment alternative almost for your clients. Yeah, then jumping into the questions, guys. First of all, thank you. It was a good presentation. And I think the first one is the most difficult one. So why is markets not reflecting that the economic data that has come out? If you say that economic data isn't bad, but yet markets has been quite bad from the Chinese aspect.
Fantastic question. I think key to the entire thing over the past few years, there really have been a lot of just noise and crap. I think geopolitically, there's been a lot of events that keep coming over and over, trying to score some own goals. So in the first phase of COVID lockdown, it did very, very well. The second phase, not so well, and opened up a little bit later. And of course, that was coincided with a clampdown on big tech, which could once again have been done better. It was much necessary, in our opinion, to have been done, but could have been done better. So part of the pledge, what Tian said about Chinese government pledging to private businesses, part of the pledge of government says that they're going to take longer in the future, right? So have more industry participation. And actually, we're still going to do the things, stop the things that are illegal, stop the things that exploit the people, but vice versa, take a longer term, don't do it so quickly, and communicate better. And I think that's one of the key things that's also come out of the last couple of years. So a combination of geopolitics, bad sentiment, earnings not coming through in the last couple of years was trying to really, really strike it on that. But vice versa, what we always want to say is that fundamentally, actually, if you look at China, it actually hasn't been that bad. And I think on the other side, which has been worse, perhaps not as good, is that if you look at China's debt situation, it's more or less frozen since 2015. So we're walking through this high debt, and debt has been frozen since 2015. But the rest of the world has caught up to China now. So the debt ratio of the rest of the world has caught up. So I think from that perspective, when we put it all together, China still does look quite attractive over the long term.
Okay, cool. There's quite a couple of questions on deflation here. So I guess, first of all, you said that you don't think deflation is a problem. What type of indicators or factors could result in a problem for deflation that really makes this a big risk?
Fantastic question. So I think from our side, let me rephrase that what I mean by I don't think it's a problem. I think if you look at the current world, if you had to choose, given where China is, do you want deflation in China or do you want inflation in China? And the answer to that is you definitely want China's inflation to be low and closer to zero than to have inflation, right? So number one, you have an indexed economy, just like the rest of the world. There's a big pile of debt. So if you have high inflation, you have to have high nominal interest rates, and that inevitably creates financial problems within the economy. By having very low inflation, actually gives the monetary authorities a chance to cut rates. That's the first thing. The second thing is having low inflation, not consistently high inflation, is actually good for your currency over the long term. So that is also crucial to us as investors, something to consider, is that although China is an exporting economy, you don't want the currency to be extremely, extremely weak. That in itself can cause other problems. The last remaining problem in China, perhaps. So earlier, so if you look at longer term, there's two big things. Number one, there's a debt issue, which has been worked through over the last couple of years, and China's been taking pain on that. And the last other one is kind of the currency, which is also on that. So all else equal, you don't want massive amounts of inflation right now, rather than deflation. So deflation can be fixed. It means that, and the worst case scenario, you can do what Japan has done in the last couple of years, print a hell of a lot of money, have a massive equity rally and real asset rally, and be done. And China is nowhere close to the problems of Japan. But vice versa, there are no low-paying options to high inflation. High inflation requires monetary authorities to tighten monetary policy. And at the current environment where growth is not overheating, that would be the bigger risk to us.
Yeah, we as South Africans know exactly how inflation is handled. Going to Taiwan. So Biden's administration recently, or this weekend, according to Devon, announced a $345 million weapons package for Taiwan. So does this introduce further risk to a China investment case?
So we don't believe that's an issue at all. The issue with the media coverage is the headlines tend to pick and choose what is covered. But I think the reason why, one of the main reasons why we don't believe these sort of weapons packages are anything significant is that we need to remember the US has provided Taiwan weapons for over 70 years. This is nothing new. It's just the fact that now it's being more reported because geopolitics is more a focus of the media. The entire Taiwanese army uses US equipment. So all of these, 345 million is not a major number. What we would want to watch out for is if the US started providing Taiwan with, for example, long-range missiles at over 300, 500 kilometers range, which they currently do not have. So what is more significant is if the US starts providing more technologically advanced weapons to Taiwan, which we do not expect to happen. If that does happen, then it is more of a political risk. But all of the play-ups on these sort of geopolitical issues, not really an issue for us. You'll notice when the Taiwanese leaders transit in the US, they receive very muted receptions from official government delegations within the US, and that is acted on specifically to not anger China in terms of the geopolitical situation. So right now, we believe Taiwan's very much in limbo. They have presidential elections next year in January. We'll have a lot more direction on geopolitics in that region after January next year. Right now, not much of a risk in our view.
So a couple of questions I'm going to try and throw into one here. So we're getting a lot of good questions. Think of this from a South African investor's point of view, taking into consideration our regulation 28 has changed. We can go 45% offshore. For the purpose of optimized diversification, first of all, how much exposure should you think should be allocated to China in addition to world equity markets? Now, this is, of course, from an SA investor with the EM position. And then obviously the other question is, why would you want to be invested in Chinese emerging markets and rather not go towards the other emerging market countries?
These are great questions. So kicking off on the second one first, I think one of the key things about China is that it's quite big and it's quite unique. So what we mean by that is that unlike other EMs that all tend to move together, China actually often moves opposite or diverse away from all of us. And that's also true compared to developed markets. So if you look at it from a diversification point of view, what you've seen is that China often is completely diversified to other markets. People always think diversified only means that, when things are good, China's better. That's not really the case. So as you can see last year, diversified means that when the rest of the world is rallying, China is not, but that's okay because in an overall optimized portfolio, you have the rest of the world going up, and vice versa. You'll find times where the rest of the world are doing 0 and China's doing 30 and 40, carrying your entire portfolio. And I think that's the key to diversification, is identifying things that are diverse and unique and not the same as everyone else. So I think that is a crucial thing of having China. And even though over the last 10 years, correlation has gotten a little bit closer, if you look at all the world's major markets, often you'll see China as an outlier. It's the one that's doing something different to everyone else. And I think that makes it very, very valuable. Now, given that's the case, that's when a typical optimized solution, we actually see a big part of the offshore should be allocated to China. So what we mean by that is, suppose, I don't know, what's the latest Red 28, 45% offshore? So if you look at something like 40, 45% offshore, what we see that at a minimum, I think, if you're not even putting in 5%, that's probably not doing much for the portfolio. You're not achieving much with your portfolio. So we typically see an allocation between 5 to 15%. And something that can be dynamic and vary according to the client. And at some of the good times, you want to allocate a lot to China, and vice versa. Other times, more neutral or lower allocations to China. But anything between 5 to 15%, we think, is something that will matter to your portfolio, that will help you reach some level of diversification and also contribute some return over the long term.
Yeah. So another question, especially regarding the long term, you guys say you feel confident in your long-term outperformance for the balance fund. So very easily, simply, what is your definition of long-term in this context?
Fantastic. For us, the long-term just means one business cycle. So one bear market and one bull market. So don't just look at it if it's only going down. Vice versa, don't just look at it when it's only going down. So I think in any model that you build, it is impossible to get it perfectly right. You're not going to get every single bottom right, and you're certainly not going to exit every single top correctly. What we strive to do is that over the cycle, we make more good decisions than bad decisions. And the result of that is that over a bear market and a bull market, we outperform 65-35 very comfortably. So if you look at our since inception numbers, we've almost compounded, more than doubled what a passive allocation of 65-35 to China would have done. And I think that's key. And over that time period, we've probably had 2 to 3 cycles. In the last 10 years, we've probably had 2 to 3 cycles. And over the next 10 years, we'll see the same. We're probably going to see 2 to 3 cycles. So typically, we're looking at around a 3 to 7 year cycle for one bear market and one bull market.
Yeah.
Just to Liang's comments, I think if one looks at our track record, especially our flagship balance fund, it actually shows the strength of our dynamic asset allocation process. So since our launch back in 2013, in sort of over 10 years and 1 quarter, I think exactly as at end of June, we've actually outperformed pure equity indexes. So the balance fund, being a multi-asset fund, we've outperformed MSCI China, we've way outperformed MSCI EM, and we've outperformed CSR 300. So we've outperformed over the long term even pure equity indices. So it actually shows the strength of our downside protection process, as mentioned by Liang a few times in today's presentation. So I think our track record does speak for itself, but it doesn't mean that we don't continue to improve our process to adapt to the changing markets. So that's what we consistently try and do. And quarter on quarter, year on year, we consistently continue to generate alpha. And I think our numbers speak for themselves.
Okay, cool. Just one thing. I see somebody has asked about the China trip. Unfortunately, it's coming through as anonymous. So please just feel free to email us about the China trip. We would be happy to give you all the information. You can just use my email. So it's chris.labuschagne@prescient.co.za. The last question is around the BRICS. And for everybody that has asked questions and we haven't gotten to, we will answer them per email. But the last question is about BRICS. So I think the BRICS GDP about 5 years ago versus the G7 countries was much smaller. And now it's started to come in very, very closely. So I guess the first question is, I think there's about 44 countries that want to get on this BRICS list. So would BRICS actually invite other countries to the party? And then what will the, let's say, outcome be if more people or more countries are added to BRICS and an idea of a world market being developed from an emerging side?
Okay. Yeah, so I think there's been a lot of talk about BRICS expanding. There are a lot of countries that want to join. We do believe it will expand, but in a stepped approach. So there's obviously a reason why a lot of countries want to join. One specific example, actually very close to our office here in Shanghai, is the New Development Bank, which is it's also called the BRICS Bank. How it works is that it helps member countries. It gives lower interest rate loans to member countries to help them to develop infrastructure, as an example. So a lot of countries would want to join. A lot of countries in Central Asia, for example, in the Middle East, we expect a certain level of expansion later this year, even as early as later this year. And it will create a separate sort of financial and economic environment where, for example, previous countries in Africa specifically, previously you would have had to only had options to go to the IMF or the World Bank for loans to try and develop its agriculture, infrastructure, etc. If they do join the new BRICS entity, they will then have access to an additional source of funding. So it's sort of a win-win situation for the current BRICS members for expansion, because you would probably need to put up capital, for example, in NDB scenario. I think they are the areas of cooperation are multifaceted. And that's why there's a lot of interest globally, and it is sort of more of a no strings attached organization compared to, for example, IMF and World Bank funding with more lenient terms, etc. So overall, we do sort of expect slow stepped expansion. It's not going to increase by 44 members in one go, for example, but it is a healthy development overall. If you want to add.
Yeah, I think overall I agree with that. I think it will take a long time. So I think because it's an emerging market, everyone's economy is very, very diverse. Everyone has different debt situations, different surplus situations, different currency situations. So it's going to be very, very slow because there's no ways to get China and India and Russia and South Africa to agree on the definition of what's going there. But I think at the core of it is that we all know developing emerging markets require infrastructure, and it requires infrastructure probably at a cost of capital that private enterprises alone are not willing to give. Private enterprises have very high barriers for profitability, for example. So something like that, that's quite required. And on the other side, you have nations in there like China, which actually have a surplus of infrastructure creating machinery, the infrastructure to create that, right? So China has built itself over the past 30 years, and that project is more or less done. That project is complete, and most of the thing is done. So they have a lot of excess capacity and excess knowledge of doing that, and doing that at a very reasonable cost. So that combined with the funding element make it attractive for many members. But due to everyone's different situations, it's going to take a very, very long time.
Yeah. Okay, and then last question. We've got about 90 seconds left. So, I mean, given the recent economic and regulatory changes in China, how have you adapted your investment strategy to navigate the evolving landscape?
Fantastic question. So there we look at each little piece and decide what we're going to do. So for example, one of the things that historically in our equity factor, we do not put a particularly big weighting on state-owned enterprises, for example, right? We pretty much neutralize state-owned enterprises, not neutral. But for this year, for example, we actually tactically added the state-owned enterprise factor at a very controlled risk amount, of course. We make sure that the factor itself is contributing limited risk. And the reason behind that, for example, is we look at the policy in China of how China has repeatedly spoken about the ridiculously low valuation of state-owned enterprises and then wanting to normalize that situation. So there it gives you a bit of a risk that if you're not, for example, part of your process, then you can miss out on a very, very big direction that perhaps if you're not in China, you're not aware that people are looking at on that side. The second thing is, of course, we always get more and more data, and as quantitative house, we try to incorporate more and more data into our models. So data are becoming higher frequency, you have more sources, some of them are useful, some of them are not useful. And as such, as an investment management house, we continue to look out for those things and incorporate them into our process if it can be done. So for example, our asset allocation model, the very, very first version, the sentiment model would have moved a lot slower than what's happening now. And that's also us adapting to the market as the market gets faster and faster. So these are typically the type of thing that we look at, that at the bare minimum, we try to get rid of the risk that comes with policy changes, but taking a step further also is to make also put ourselves in a position where there are opportunities for alpha as well.
Okay, great stuff. Yeah, so we've got a lot of questions. Unfortunately, that's all we have time for, but we will get back to you and we will mail you the what we believe are the answers. There's never a real or a right answer. Tian, Liang, thank you so much for joining us. We hope that it's much the weather's better in Shanghai because it's been very cold here in South Africa. But thank you, ladies and gentlemen, for joining us, and we look forward to hosting you again next quarter. Have a lovely day and a great week further. Cheers. Bye.
Thanks. Bye.